From the morning reading, the bull market celebrated its 6th birthday on Monday. The milestone put the rally in an unusual club. Since World War II, only 3 other bull markets made it to year 6. Just 2 made it to year 7. Past bull markets have ended with trailing price earnings ratios varying from 8.8 in 1980 to 27.0 in March 2000. As of yesterday's close, the S&P 500 is trading at 17.3 times 2014 earnings. 5 bull markets have ended at higher price earnings ratios, with the 6th ending with a PE of 17.2. Since 1962, there have been 37 other times the S&P set a multi-week low while above its 200-week average and enjoyed a thrust day of more than 1%, with more than 2 advancing stocks for every declining one on the New York Stock Exchange. It tended to lead to gains. 3 months later, the S&P was higher 84% of the time, averaging plus 4.9%, but 48% of the time it dropped back to a new multi-week low before rallying, an average doing so within 7 trading days. Given the negatives outlined earlier this month, such testing behavior seems more likely than yet another V-shaped bottom. Very much what we've been talking about in recent days. It's going to require some really nimble trading where you have often, as we did yesterday, a very bullish short-term outlook, an intermediate-term outlook that is bearish, and then a very long-term outlook that is bullish. And as you see with when bull markets become kind of long in the tooth, and in years in which the Fed is starting to raise interest rates, volatility becomes much more common. And you start seeing these kinds of circumstances which require for very nimble trading. And that's very much of what we're going to deal with, not just this week, but probably in the weeks to come. Well, that's the opinion. Well, let's see what the facts are about our overnight activity. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:02 a.m. Central Time, and I'm recording this in preparation for the market day of March the 13th. That's right. Friday the 13th. We've got at least, I think, 3 Friday the 13ths in this calendar year, but it is March the 13th of 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So, what did happen overnight? Well, really not all that much. The 4 broad market indices as of the time I cut this were marginally higher to scratch, with the Russell being the strongest at about 0.25%. You had crude oil down fairly sharply, down almost 1%. The euro is up just marginally. Bonds are down about 0.4%, and gold is up marginally. So for the most part, the takeaway on the overnight activity is very, very, very quiet. In overseas markets, China up about 0.7%, Hong Kong up marginally, Japan up healthy 1.4%, Germany scratch, United Kingdom scratch. So fairly bullish activity in Asia, but leading to a fairly much a scratch market in Europe, and that's pretty much reflective of what our own markets are doing as of the time of this cut a little while ago. In terms of macroeconomic reports, for Friday, we do have the PPI report at 7:30, and then we have the University of Michigan during the market trading day. So be aware of that for those intraday traders out there. In terms of volatility, current volatility conditions came down a little bit yesterday. Obviously, big up day. Short-term VXST 15.04. You see the historical IV percentiles dropped, and actually, are relatively low with 3 of the 4 broad market indices in the bottom third. We did have a greater than 1 standard deviation move yesterday in all 4 broad market indices, with the NASDAQ probably being the less volatile. And most of these values are actually close to 2 standard deviation moves. So pretty good activity, with 3 of the 5 last trading days being a standard deviation move or more. Not all in the same direction, of course. And then let's take a look at our daily report. You should be on the new contract in the euro and all 4 index futures today. Volume should be greater on new contracts versus the prior contracts on all those contracts at this point. Still, intermediate term phase opinion phase 3, looking for higher highs and higher lows. Though we do have flies in the ointment, IBD status is still uptrend under pressure. GMI index improved slightly yesterday to a 3 out of 6, still with a buy signal. Active trader market posture is bearish, so that kind of goes to the different time frames. Remember, investor posture is looking for a longer term time frame. Active trader posture more of an intermediate swing term time frame. From position sizing, that investor position sizing, buy alongside portfolio exposure up to 50%, and really calling for not to initiate new bullish positions, mostly to manage existing positions unless you've got something really, really sweet. And then at that point to take some caution with your position sizing given the current market portfolio and posture standings. From a volatility standpoint, that position sizing opinion is still at 75 to 100%. The VIX is still less than 18, so even though we've had a good bit of volatility that has come back into the market in recent days, it has stayed relatively stable. One-day market timing outlook was slightly bullish. Much of the edge came off with the big move yesterday when we were much more strongly bullish in our short-term market timing opinion. 3-day outlook slightly bullish. Market forecast posture bearish for 3 of the 4 indices. The Russell did manage to turn up and on the intermediate market posture line give a little bit of a positive signal, so that turned it back first day bullish. Threshold level still remains a 1. Volatility metrics, we did see some of them go back to normal status yesterday. From a volatility standpoint, really the only thing that stands out is the distribution day count on the S&P is at 5, which is right on the threshold of becoming pretty worrisome. You have really nothing else in those measures that we typically look at in this area that really stand out at this point. Everything is pretty much normal. You see the New York Stock Exchange new highs, new lows, 212, 214. Really nothing exceptional there. Our opinions with respect to option income strategies, VIX is inside the acceptable window, gives a go-ahead. Cover call strategies, looking for an equal distribution between in the money and out of the money strikes. And certainly I know I've had a couple of my own cover calls roll out for another month lately, and this equal distribution between in the money and out of the money seems to be working out really well at this time given what the market has been doing in recent weeks. Put selling slightly bullish, so acceptable to sell puts against the core portfolio baskets that you are willing to own and the position size that you are actually willing to take possession of. And other activity that's specific to today, sector market posture. Quite a bit of improvement in this yesterday. You recall yesterday it was pretty much all red on the short and intermediate term. Obviously, some of the indices were able to bounce above. Because of the recent ranging activity, these lines are largely flat, so they can flip back and forth all the way from down to up with literally 1 day's action. So should take some caution into the meaning of these. Really, we're looking for consistency, and in terms of consistency, certainly healthcare, probably the most consistent in terms of bullish performance. Financials has been strong at times, but also terribly weak at other times. Retail, probably also another area of consistency. From a sector percent change, obviously big day yesterday. Financials were the big hero. Energy continued to struggle. Energy may be setting up to carve another new low. Shadow Trader Retail, Shadow Trader Industry Group rankings: retail, railroads, internet, healthcare, transportation, all still in the top, followed by biotech. No changes really there in terms of the industry groups of note. Let's see. Well, as always, greatly appreciate you liking us on your favorite social media platforms, including this YouTube channel. It does help for your showing that you appreciate what's being done here, both in letting me know so that I continue to be encouraged to do this each day and produce these videos, but also to allow other traders to understand just what it is that you're finding of value. Questions and support at falconglobaltraders.com. More information at the website, including about the free trials at each of the 3 live trading rooms. Disclaimers, as always. Hit the pause button if you need more time to review the disclaimers. Greatly appreciate you each and every trading day in the Falcon Global Trading community. Good trading, and we'll see you back on Monday morning.